right. Good morning, everybody. Happy Thursday. Is it Thursday? What day is it anyway? Man, these days are blurring together. Why? Because I love this job. Today's Thursday, August 17th, 2023. Top story this morning is Walmart. Walmart and, of course, China. Always China's got to be in there. First, Walmart. What a quarter from Walmart. Dare I say a near perfect quarter from Walmart. They did everything right that Target did wrong. Walmart is eating Target's lunch. You'd never know if you looked at the stocks because yesterday Target was way up on that awful quarter that they posted. Today, Walmart posts a beauty of a quarter. Their stock was down for a minute there pre-market. Looks like it's up modestly at the moment, but barely moving. And some of the highlights here real quick. E-commerce at Walmart was up 24% year over year. Target's was down 10.5%, but Target stock was up yesterday. Same-store sales up 6.4% for Walmart. Target's were down 5.4%. Walmart is just stealing market share from Target. And yet the two stocks are going in opposite directions, Target going up and Walmart staying the same. Net income up 33% at Walmart. In this environment, in this retail environment, where debts are everywhere and consumer spending is slowing, this is an amazing quarter from Walmart. Absolutely amazing. Now, Walmart's probably benefiting from people being pushed down the luxury ladder by inflation. You got more people shopping at Walmart versus 2 or 3 years ago when the stimmies were flying. People were all like, oh, I wouldn't shop at Walmart. Oh, no, I'm a Target shopper. Now I shop at Walmart because I'm broke. That's what's going on in the economy right now. Now, Walmart's pivot to grocery has been the benefit, has mainly been what's driving this benefit because people are saying, well, I'll go to Walmart to buy my groceries, even though the fresh produce at Walmart makes me want to puke when I go in there. But other people like it. And while they're there, I guess I'll look at a big TV. While I'm there, I guess I'll look at other things, apparel, discretionary items. Walmart's firing on all cylinders right now. Target did not make that successful pivot to grocery that Walmart did, and they're suffering from it, as well as from other issues, as I'm sure people are pointing out in the comments right now. Keep it clean, guys, please. So really good news out of Walmart. Lastly, we've got China this morning. They're defending the yuan. China is dumping U.S. dollars. Now, I don't want to get too hypey, too much hyperbole here. This isn't the China's dumping our debt story. Oh, we owe all this money to China. They're going to dump it, and they're going to screw the United States. Not really how that works, guys. China only holds somewhere around $800 billion of U.S. treasuries, which is a lot. But that's less than the, say, Japanese $1.3 trillion that they hold, and certainly much less than the, $6.5–7 trillion that the Federal Reserve holds. China actually doesn't have that much U.S. debt. But it's enough that if they were to start dumping it, you bet they could send yields higher. And, well, they're dumping dollars. We're not quite sure they're dumping U.S. treasuries yet to get those dollars, but it stands to reason that that would be what they're doing. So yields are moving higher. Now, when China dumps dollars and buys yuan, the Chinese currency is not part of the DXY. It's not part of the Dixie math. So there's no direct effect on the DXY chart or the strength of the U.S. dollar is measured against other currencies. But there are knock-on effects because as the yuan were to get a little bit stronger against the dollar, you may see yen arbitrage to yuan and then into dollars or something like that. So there would be second-order effects that could bring the DXY chart lower. And we're seeing that this morning. The DXY was a little bit lower today. But the yuan is strengthening against the dollar after weakening substantially over the last few days because of the collapse of the Chinese real estate market. So the Chinese government, their central bank, and their state banks, at the behest of the Communist Party, they're acting to defend the Chinese currency, which was in free fall because of the real estate collapse, which continues into today. And also, shout out to my moderator, Mish. He caught something from a few days ago. Big banks dumping commercial real estate loans. Put a pin in that one. We're going to talk about that. Might have to break out the tinfoil hat this morning. And with that, let's shrink my big melon of a head. And while we're shrinking my big melon of a head, won't you please inflate that like button? It really helps me with the YouTube algorithm. I'd be forever in your debt. And if you're new to the channel, won't you please subscribe? We do this every morning, and we'll see you tomorrow. Here's the Fear and Greed Index at CNN is at 51. Still just one little itty-bitty tick into the greed side. Almost even neutral. Fear slowly returning to markets, very, very slowly. Still just one tick in the direction of greed, but otherwise a neutral market right now. After spending months in extreme greed territory, we are finally back to neutrality. So the market is getting a little bit more fearful. Well, it's getting a lot more fearful, but still a neutral market. Let's look at the S&P futures this morning. Looks like the S&P is at the moment set to open about 12 points higher, or about 0.25%. Not a big change, especially considering the week that we've had. Let's take a look at the S&P for just a second here, because yesterday we talked a lot about the moving averages, and I just want to show you right here. We were showing that 50-day moving average. There it is. We broke below it a few days ago. We came up yesterday, and look at that, guys. Almost, look at the wick on that candle, almost to the 10th of a point. Right on the 50-day moving average. The algos took us up to retest that, and then they sold off. We had a big move up in the open yesterday, particularly in the Dow. I think the algorithms just decided we were going to buy. Yesterday morning at the opening bell, we saw all of the Dow components were going up by about 1.25%. No rhyme or reason. Caterpillar was up 1.5% yesterday morning. Caterpillar, who sells bulldozers in China, as if that business is looking optimistic right now. But it was really just the algorithms were saying it was time for a market reversal. Took us right up to the 50-day moving average, and then the breakers, not the breakers, the algorithms swapped over and went back into sell mode. Now, the Dow is set to open about 16 points higher, basically flat, 0.05%. And the NASDAQ is looking pretty good this morning. The futures are up 63 points, or about almost 0.4%, or almost 0.5%. Again, the NASDAQ looking a little bit worse than that S&P chart on the long-term one. You can see the 50-day moving average. We lost that a few days ago. Came up, retested it once, failed, retested it again, failed, and now we're heading lower. So the NASDAQ chart is looking pretty ugly. But guys, this decline, it's getting a little long in the tooth. It's been about 2 weeks now of this slow grind lower on the NASDAQ. We're due for a bounce. I'm not saying we're going to get it right now. Maybe we do, maybe we don't, but we're due. We've been heading lower for a while. Markets don't move in straight directions, markets don't move in a straight line in any one direction. It's choppy and it bounces around. Market's due for a green day. Let's just put it that way. DXY right now is at 103.15. That's down 27 basis points this morning. This, again, knock-on effect, in my opinion, of what the People's Bank of China is doing, what China's state banks are doing, dumping U.S. dollars in order to buy Yuan. Again, that's not a direct correlation because the Yuan is not part of the DXY math. But if the Yuan starts to strengthen against the dollar, you're going to see movement in the euro. You're going to see movement in the yen and the pound and all those other currencies that go into the DXY. So I think the Chinese dumping dollars is what's sending the Dixie lower today. Now, again, on the long-term charts, let's look at this one because we lost the 200. Well, we recaptured the 200-day moving average yesterday on the DXY. We blew right above it. Major bullish indicator for the dollar. Well, we're retesting today on this news of the Chinese dumping the dollars, and we have failed that first retest, at least at the moment, heading back lower. We'll see if that has any legs. And looking over at the bond market this morning, we've got the long end of the curve is up, and the middle, the short end, is pretty much down. The 30-year is up 4.5 basis points at 4.4%. Look at the 10-year, up another 3.5 basis points, yielding 4.29, almost 4.3. Guys, bonds, this breakdown in the bond market is getting dangerous. We need to turn here. The bond market needs to turn the other way, or something bad is going to come. I don't know what it's going to be. But at 4.3%, things broke at 4.2%. Things broke at 4% before. We're now at 4.3. We can't afford this, and we're going to see something in the Walmart numbers that's going to show you why. The 2-year Treasury, 4.95%. That's actually down 3 basis points, and the 1 month being pegged at 5.37. Now, look at the 10-year chart, guys. This is a breakdown in the bond market. I know this looks like it's going to break to the upside, but this is the 10-year yield. And keep in mind, yields and prices are inversely correlated. If you see bond yields going higher, bond prices are doing the opposite. And right now, bond yields are looking at a breakout. Check out this red line. This is the previous high closing from back in October 24th of last year. We have now retaken that high, and we are moving higher. This bond market needs to turn lower soon, or something very bad is going to happen in markets. Some big bankruptcy, some big insolvency, I don't know what. But interest rates going higher in an economy that is as hopelessly dependent on debt as ours, something bad is going to happen if this chart doesn't turn soon. And looking over at the commodities, gold and silver may be forecasting that this morning. because we've actually got December gold futures are up $4 despite higher yields. That usually doesn't happen. 1,932 for December gold futures. And look at silver. September silver futures up 47 cents this morning, or a full percent, even though interest rates are higher. That doesn't usually happen, guys. Interest rates and precious metals usually go in opposite directions. Maybe the lower DXY is driving this, maybe not. But it could be that metals traders are starting to make bets on interest rates turning lower. It's just one possibility here. Big move in silver this morning, though. Congratulations to the stackers. And crude oil, West Texas Intermediate, September futures at $80.59. That's up $1.21 this morning, or a full 1%. Not sure what's driving that move in oil at the moment. Let's take a look at the gold chart here, guys. Again, another chart that looks like maybe a reversal could be happening. If not a reversal, then a major breakdown, because the price of gold, there we go, just lost our 200-day moving average a few days ago, came right up. Look at that, just a tick above the 200-day moving average yesterday. Lost it, ended up closing lower. Looks like today we're going to make another run at that. Watch that level of about 1907 in the spot price of gold. That is your 200-day moving average there. All right, looking at Walmart right now. This is a big story this morning. Probably what's driving stocks a little bit higher. Walmart raises full-year forecast as grocery and online growth fuel higher sales. Again, everything Target did wrong, Walmart did right. Walmart is just straight up eating Target's lunch right now. They lifted their outlook for the full fiscal year after beating Wall Street's expectations for sales and earnings. That's after Target lowered their guidance yesterday. E-commerce sales for Walmart jumped 24% year over year. That's after Target's e-commerce dropped 10.5% yesterday. The chief financial officer, John David Rainey, said that there were modest improvement of sales of big ticket and discretionary items in the quarter. Target said big ticket and discretionary items were way down in their quarter. So you see, the grocery gets them in the door. While they're there, some people are buying other more expensive items. Now, I just want to scroll all the way down through the fluff here. Here's the meat and potatoes of this story. Earnings per share, $1.84 versus expected $1.71. Now, there was a little bit of that inventory adjustment lower that we saw with Target. Not nearly as much as Target, though. So these are legit earnings here. Revenue growth, $161.6 billion versus $160.2 expected. So we got a beat on the top and the bottom line. Now check this out. Walmart's net income for the quarter jumped by 33% to $7.89 billion or $2.92 a share, compared with $5.15 billion or $1.88 a share a year earlier. Just a monster quarter from Walmart. And look at Walmart stock, up 0.5%, 0.65% pre-market. It was actually down for a little while this morning. This time yesterday, when we were talking about what a terrible quarter Target had, Target stock was up 7% pre-market yesterday on a 10.4% decline in e-commerce and a 5.5% comparable sales decline. Now here's Walmart posting a 6.5% increase in their comps and a 24% increase in their e-commerce, and their stock is up 0.6%. Bizarro world in retail stocks. What can I tell you, folks? Now, I got to send a shout out to my man Frog Capital on Twitter, who is at Frog News. He posted this screenshot of Walmart's income statement today, and there's something I want to zoom in on here. And I mentioned the interest rates and how the 10-year yield going higher and how it was going to break something. And it's not going to break Walmart, but this Walmart income statement kind of shows you how that might happen. What we're looking at right here, these two numbers for the 3 months ended July 31st. All right, this is showing what the interest income or interest expense, because it's in parentheses. Here you go. Last year, Walmart paid, I think this is in millions, yes, $31 million in total interest expenses for Walmart last year in the quarter that ended July. This year, $148 million in interest expense for the quarter ended July 31st. That's an increase of 377%. They quadrupled their interest expense. Now, Walmart's a big company. They've got cash reserves. They've got pricing power. So they've been able to absorb this. But a quadrupling of interest expense, this is the failure mode of so many companies. This is why we're seeing this spike in bankruptcies. Why, as of August, we've already got more bankruptcies in big companies this year than we had in all of last year combined, because of this interest expense going up. This is how Fed interest rate hikes kills companies. You can see it right here in Walmart's income statement, a quadrupling of their interest expense, $148 million versus $31 million in the same quarter a year ago. Also, let's talk about China right now because this one just hit a few hours ago. China's state banks are seen selling dollars for yuan in London and New York hours. So they're doing this round the clock, not just while they're awake. Some traders in China were kept up all night to dump dollars in New York and London markets. China's major state-owned banks were seen busy selling U.S. dollars to buy yuan in both onshore and offshore spot foreign exchange markets this week. People with direct knowledge of the matter said, of course, nobody ever gives their name. You can't quote anybody. Got to be anonymously sourced, right? This is in an attempt to slow the yuan's depreciation. Though they also trade on their own behalf or execute clients' orders, state banks often act at the behest of the central bank when the yuan is under pressure, as it is now. State bank dollar selling has become a new normal. I'm so sick of that phrase, new normal, to slow the pace of yuan depreciation, said one Shanghai-based trader. Offshore branches of the state banks were also seen selling dollars during London and New York trading hours this week, two sources with direct knowledge of the matter said. So the Chinese are dumping their dollar reserves to prop up the yuan. Why are they doing that? Well, take a look at this chart. This is the value of the U.S. dollar as measured in yuan. This is USD CNY. So as this chart heads higher, that means it takes more yuan to make $1. As this chart heads lower, that's fewer yuan to make $1. So as this chart goes higher, the yuan is weakening. And you can see really since February, the yuan has been weakening against the dollar. And this last couple of weeks here, it's really weakened to a point where we got as high yesterday as 7.31 yuan to the dollar. And guys, that is as high as we've been. That actually matches the high that we saw back in November, the last time Asian banks started intervening in Forex markets by dumping U.S. dollars. And you can see what the result was last time they did that. The yuan strengthened dramatically over the next few months versus the dollar. You can already see it here on this candle, big red candle down. This is Chinese banks dumping dollars to buy yuan, and the yuan strengthening, sending this chart lower. Last thing I want to talk about, guys, is this one here. Big U.S. banks are reportedly trying to dump commercial real estate loans, but buyers are scarce as pressures mount for property markets. And I need your tinfoil hats for this one, guys, because I have a theory. Here we go. I have a theory on what is going on here. Why are big banks selling commercial real estate? Well, let's talk about it first. Big banks are trying to dump commercial real estate loans as pressures mount in the sector. JP Morgan, Goldman Sachs, and Capital One are among those trying to shed debt exposure, sources told Bloomberg. Some banks are having trouble securing buyers and have been holding on to loans as they search for a deal. And there's a couple of specifics in here. JP Morgan, for instance, has been looking to sell a $350 million loan backed by the HSBC Tower in Manhattan. Now, $350 million for JP Morgan, not even a drop in the bucket, right? This is chump change for them. But the bank is offering potential buyers ultra-low interest financing. Capital One has also been trying to dump its portfolio of office debt based in New York. Sources said the company's chief financial officer stated last month that the bank is seeking to sell $900 million of office loans. And Goldman Sachs, they've been looking to sell their loans on hotel and apartment building, sources added, while M&T is also looking to shed hotel loans. Now, this is interesting. Why am I tinfoil hatting on this one this morning? Because all of the other players that are really exposed in the commercial real estate space, the little banks, the real estate investment trusts, they're all going to great lengths right now to avoid selling any commercial real estate because they know there's no buyers and they know any selling will lower prices and crash the remaining assets on their books. So you've got stories like BREIT, the Blackstone Real Estate Investment Trust, slamming the exits on their flagship commercial real estate fund because too many people were trying to withdraw their money. And if they had to withdraw their money, they would have to sell some of their commercial real estate holdings, and that would drive the prices lower. So they're not letting people out of the fund. You've got all kinds of things are going on in the CMBS market and all of this borrowing from the Fed's discount window and the bank term funding program and federal home loan banks, companies taking out expensive debt to keep these losing bets on commercial real estate alive, all to just avoid having to sell anything because they know if they sell, they're going to drive the prices lower. So why then are the big banks doing the opposite? Why are the big banks selling? Maybe that's because the big banks want those prices lower. And this is why I've got this on today. Because so far as every bank has failed in the United States, the little banks go down, the big banks have gotten bigger. JP Morgan has been the chief beneficiary of everything that's happened in the economy since March. They bought up chunks of all of these failed banks for pennies on the dollar. The big get bigger as the little guys get hurt, and the taxpayers pick up the difference in the form of the FDIC hits to the Deposit Insurance Fund, or higher interest rates being paid on loans, or lower interest rates being received on our accounts. So the big banks want commercial real estate to go lower because the big banks know most of the commercial real estate debt in the country is on the balance sheets of little banks that can't absorb those hits. And if those little banks start going under, the big banks know they'll be able to buy up the pieces of those little banks for pennies on the dollar. And JP Morgan and Capital One and Goldman Sachs, they know that the Fed will step in with ZIRP and BRRRR, zero interest rate policy and the money printing, long before any of the big banks in the U.S. fail. They'll let the little banks fail, but if they were going to bail out Silicon Valley and if they were going to bail out First Republic and Signature Bank, then they'll definitely bail out Bank of America or JP Morgan. So the big banks are selling their commercial real estate because they know it'll send the prices lower. They know it's going to fail smaller banks, and they know they'll get bigger when that happens. So they're intentionally trying to light the brush fire in the commercial real estate market by dumping their own meager holdings, and there's not very many, into a very illiquid market that could further drive those prices lower. That's my tinfoil hat theory on why the big banks are trying to dump their commercial real estate loans. Now, they could be doing it because commercial real estate is just a lousy asset class right now, and it's good business to sell them. But all the people, all the big players in that market are not selling because they know they can't sell and that they could trigger that wildfire in the commercial real estate market if they do it. All right, guys, that is all I got for you today. I want to say thank you so much to everybody for your time, for watching this morning. Thank you to my Patreon supporters for everything you do for the channel. I had a great time talking to you guys yesterday on our weekly Zoom call. I'll be posting the recording of that Zoom call to the timeline in the minutes and hours following this very live stream. I appreciate everything you guys do for the channel. There's a link down below should you feel so inclined. Hi, Mom. Hi, Dad. I love you guys. And until next time, live small and dream big.